Just as stocks hit fresh all-time highs, geopolitics are back in play. The U.S. seized an Iranian cargo ship over the weekend, sending oil higher and stocks lower. So now the question is this rally built to last or just a relief bounce? George Seay is founder and chairman. Annandale Capital joins us now. George, great to have you back.
Thank you, Caroline. Always great to be here.
So what's your call, George, after that double-digit move in all-time highs? Is it built to last or is it fragile?
You know, we've had a big move here in about 10 or 11 days, a historically dramatic move. I think it's only been that fierce 5 times in the last century or so, so it's quite a move. But the market is really rational the way it perceives these things. Iran is 0.5% of the global economy. And yes, it's really messy over there. And yes, the price of oil is much higher than it was 3 months ago. But the market is looking at earnings and looking at the U.S. economy and saying, this is a juggernaut. It just can't be stopped. It keeps going up. The data we're receiving is almost universally optimistic and positive and strong, and it's going to stay that way. And the market just really wants to go higher. Overnight, you saw oil tick up 7%. You saw stocks tick down about 1%, and yet we opened near flat on the market, and oil is only up about 3%. So the market, the investing community is very comfortable that the U.S. economy is strong, will remain strong, and they want to buy stocks.
Has the market officially disconnected from geopolitics then? Because to your point, we are seeing red arrows right now, but they're pretty modest given the fact that we did see that tick up in oil and also that we saw an escalation over the weekend.
Yeah, you see the historical data is pretty decisive that geopolitics long term have almost no effect on the markets. It's all about earnings and growth and the prosperity of various economies around the world, in particular the U.S. So although it can affect the data and probably will affect the data from an inflation standpoint, and a commodity price standpoint, and a rate of economic growth standpoint, the market's got to see that data or anticipate that data before it prices it in effectively. And I think the market is anticipating it's not going to be that big a break or friction cost on the economy because it just doesn't influence the U.S. that much. Now it's going to influence Europe and Asia much stronger because they're much more affected by this because they don't have such dynamic oil and gas production like we have here in the U.S. But the market is basically saying, yeah, this is bad, but it's not that bad. Let's keep buying stocks.
The only issue, though, is you've been on multiple times before, and you've said that we kind of have to reset our mindset in terms of what feasible returns on the market can actually be, saying maybe more like 6 to 8% versus 20% like we've been used to. And the S&P 500 is now up, what, almost 4% year to date. So are the gains from here pretty limited?
Well, we'll find out. I think it's going to really depend on earnings growth and then projections of earnings prospectively and how strong that is. If it continues to be really strong, we can definitely march quite a bit higher from here, but it's got to be really, really strong. To your point, 4% in the first quarter, which is basically what we've gotten plus a couple of weeks, is an annualized rate of about 15%, which is close to what the market's done the last 15 and about 50% above the historical mean of around 10% a year. So it gets a lot harder from here. It's a valid point.
So what's the play here? Do you buy any dips? Do you sit tight? Do you start trimming? What do you do?
Yeah, I certainly wouldn't chase the Mag 7 here. They've had an explosive move to the upside, and probably it's a sell the news reaction on earnings unless they beat expectations and project higher growth than anticipated going forward. But I would buy some stuff that's kind of gotten beat up a little bit. I don't think the oil and gas stocks have fallen far enough to be super enticing, but they've fallen enough to maybe nibble at them a little bit. And I also think financials have really lagged the market pretty much. So I'd be looking hard at quality financials, especially in the insurance space. But this is a time to kind of reflect and watch and make sure your allocations are what they should be and adjust accordingly as necessary. But if you're at the right allocation, this is a good time to just kind of watch and see what direction the market takes from here.
So dig into that a bit more. What financial stocks do you actually like? What are some names that are on your shopping list or that you would scoop up right here?
Yeah, I bought JP Morgan about 2 weeks ago because I thought it had been beaten down about 10%, and I wanted to buy quality if I bought a bank. And then I really like Berkshire Hathaway in here. It's kind of been left behind the market rally in a significant way because markets haven't decided whether they like Greg Abel or not yet, and they're decisively saying they really don't like Warren Buffett retiring. So I think you've gotten a Warren exit detriment to the valuation placed on the stock. I also like a reinsurance company called Arch Capital Group quite a bit. It's an incredibly run company. its return on equity is off the charts. So those would be examples of two really high quality insurance companies I'd want to be nibbling at here.
And it sounds to me like you think that the tech bounce back that we've seen is starting to look stretched. What about defense? Because that's been a major outperformer over the past year. Names like GE Aerospace, Raytheon, Boeing are all reporting this week. Is there still an opportunity there, or do you think that trade is getting crowded?
It's pretty crowded. They probably go higher from here, especially if the Congress passes anywhere near Trump's requested $1.5 trillion defense budget, which would be historical and more along the lines of the Reagan defense buildup in the 80s. The ironic thing is President Trump's been very pro-military, very pro-defense. He's obviously ordered quite a few global engagements in Venezuela and Iran and around the world since his second term started up. But he really hasn't raised defense spending that much yet. He's had a lot of rhetoric pro-defense, pro-increase the military budget and size, but he hadn't really done anything till now. And this is a big move in that direction. So if that passes, there's more room to run with the defense stocks. But yeah, they've run pretty hard. It's a crowded trade.
So what does the right allocation actually look like today?
Well, if you're a perpetual endowment and you've got hundreds of years to work with, you're 70% or more stocks and 20-30% or more private equity and alternative investments, and you probably hold very little bonds because you've got plenty of time to grab the highest returns you possibly can. If you're a retiree turning 85 and you barely got enough money to make it to 100, if you're fortunate enough to make it to 100 with your health and your mind intact, you're probably 80% bonds, 70% bonds, and the rest equity. So it really depends on your circumstances to a great degree.
But break down the equity exposure. As you know, you had talked about tech being stretched here, defense maybe being stretched, but potentially seeing some opportunities in financials and energy. How should we be thinking about our portfolios overall in terms of what sectors we're allocated to?
Yeah, that's the right question. And I think people have just crowded into the Mag 7 trade for a good 5, 6, 7 years now, and it's although they do business all around the world, and you've got immediate global diversification just from owning them. I don't think that's a really wise way to move forward. I think that you want some international exposure, you want some emerging market exposure. You probably want something, whether you're active or passive, that kind of models the MSCI, which is around 60 to 65% U.S. and 35 to 40% the rest of the world. So for a portfolio's equity allocation, I would model the MSCI in terms of the components, and you could tweak it here or there, whether you have a 6% energy weighting instead of 3% like the S&P 500 index has. So you can tweak it somewhat, but that's a pretty good model to follow going forward.
The only issue, if you didn't have exposure to the Mag 7, you'd have missed out on an 18% monthly return so far for Amazon, Meta, Alphabet, Nvidia, and Microsoft are up about 14% so far in April. So should your exposure there just be, you should have already been holding them, or should you have exposure through the S&P 500? What are your thoughts there?
I would say your latter 2 points, already be holding them or holding the S&P 500 index, which is about 40% weighted to those securities, is definitely the way to go. If you don't have any exposure whatsoever, I'd be nibbling at the ones that have lagged a little bit recently and not done quite as well as the others. But I certainly wouldn't chase Meta and Amazon and Nvidia after they've gone up probably about 18 out of the last 20 days on the market and have gained 15-20% in short order. I'd wait for your moment. And also, I think it's a good reminder that about a month ago, these stocks all dove anywhere from 20, 25, 30%. And you had an opportunity for the first time in probably 3 or 4 years to really buy Microsoft at an unbelievable multiple. So when those things happen, when the market panics, that's when you want to be decisive. You don't want to have a FOMO trade and just lunge at these things after they've already run significantly, because your prospective returns are likely to be light and disappointing if you do that.
Okay. So you talk about earnings. Really, this is a market that's kind of looking past geopolitics and focused on earnings. We'll hear from 20% of the S&P 500 this week alone. Do you think earnings will actually have what it takes to keep this momentum going? And really, I should say guidance. Do you think the guidance will surprise enough to the upside to keep the momentum going?
I think that'll be security by security on a security by security basis. You know, like they say, it's not a stock market, it's a market of stocks. And the expectations now are so high, and we do have a lot of geopolitical Sturm und Drang. So I think that investors are wise to kind of take it case by case, because some companies are going to announce and then they're going to get knocked down because they don't hit their guidance as well as they'd like. JP Morgan went down after record earnings last week, for an example. And you're going to have it. Some stocks outperform to such a degree they keep going up, and some not so much. So that's back to the point of the market gets a lot harder here because it's not an automatic reflex buy everything and it's all going to go up. It's going to get much more selective going forward.
So harder to move higher, but do you think the worst is behind us?
I have no idea, to be honest. I think you see on TV, you see talking heads come out and they've got an answer for everything. And the more honest answer sometimes is you just really have no idea what's going to happen. I mean, last week the Strait of Hormuz was open and we were going to cut a deal with the Iranians, and now today we're not even sure the Iranians are going to show up in Pakistan to negotiate. And the Strait of Hormuz is not open yet. And the market's still betting by the end of May. I think they give it a 62% chance in the gaming waging markets that it's going to be open by then, but nobody really knows. That's a good example of why. Make sure your allocation is okay and just sit tight, because you got a huge move in the last 2 weeks and nobody was looking for that. You just don't know.
Well, I appreciate your honesty there, and you've given a lot of good advice so far, but what do you think, given the potential volatility that we could be seeing, given the uncertainty, what's the number one thing investors should be doing right now?
I'd say reading as much as they possibly can, not getting consumed by the market's day-to-day gyrations, which sometimes have rationale behind them and sometimes they just don't. And make sure your long-term game plan is spot on, that you have a strong game plan, you're executing on it, and you're positioned the way you want to be for the next, not just month or quarter, but for the next 5 years.
Do you think that this could be a year where sell in May and go away will actually make sense?
I actually do. I actually mentioned that to my team here at my company last weekend, that this actually might be a sell in May year. Time will tell, and a lot of it's at the end of the day, it will be completely dependent on earnings. And yes, the price of oil will impact earnings. So if oil goes back over $100 a barrel significantly and stays there, I personally think that oil doesn't really start to affect the economy that much until it's well over 120. So I think we can stomach what we've got right now, but it's just going to be earnings, 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 and how much economic growth we've got in this country.
And let's just break down what that actually means, because all too often or I shouldn't say all too often, but often the investment advice is stay invested. Yet if it's a sell in May and go away year, what does that actually mean?
Boy, that's a great question. What it means is you trim. It doesn't mean you eliminate equities and try to time the market. Timing the market is not tax efficient, and it's a loser's game, because you've got to get two things right. You've got to get the timing on getting out right, and you've got to get the timing on getting back in right. And usually if you sell in May, they say buy back in October or November, but you're still timing, you're still incurring a tax bill for doing something like that. So I would look to trim things that have run too far, and if your allocation is over your target allocation, trim back to that allocation right now. I think that makes an awful lot of good sense. But the great statistic they keep rolling out is that if you miss the best 30 days in the stock market in roughly the last 30 years per year, which is basically about 1 day a year, your average return goes from 10% to 5% per year. And if you miss the best 60 days over the last 30 years, which is basically only two days a year, your return, believe it or not, goes from 10% per year to 0% per year. So you want to stay invested, but you want to make sure you trim at points when you're over your target allocation and add when you're under it. So that's the discipline of maybe sell on the margins in May, maybe add on the margins in the fall if you drop below your target allocation.
Okay, I think that's a good point to clarify there, and I think it's a great chance to pivot to our rapid fire game of this or that. You've played with us before, George. Are you ready? Quick questions, quick answers.
Play ball.
All right, here we go. Real rally or relief rally?
Relief rally.
Market strength or market confusion?
Market strength.
Stocks higher from here or due for a reset?
Temporary reset, higher eventually from here.
Momentum intact or exhausted?
Intact.
War headlines, ignore them or trade them?
Ignore them.
Oil at 90, headwind for stocks or manageable?
Manageable.
Level that they become unmanageable?
135.
Fed cut soon or Fed stays put?
Fed stays put.
Safe yield, high dividends or bank stocks?
Bank stocks.
U.S. resilience or international rotation?
Both.
Broad market exposure or biggest names?
Broad.
Quality growth or deep value?
Quality growth every time.
Best value play in the market right now?
Small cap stocks.
More upside after the latest run, Alphabet or Amazon?
Amazon.
Amazon or Nvidia?
Amazon.
Earnings, high bar or easy beat?
High bar.
One word to describe this current market.
Powerful.
Sell in May or stay and play?
Trim and stay in play.
George Seay, always a pleasure. Thanks so much for playing. Thanks for your picks and your perspective.
Thank you, Caroline.
That's George Seay, founder and chairman, Annandale Capital.